welcome back. Here is the study guide for the midterm. Okay, it's about 50 questions, so let's go ahead and go over them just to review chapters 2 through 11. Okay. All right, first section here is chapter 2, where I'm going to be asking you a series of accounts, and you are here to determine the account type, the account category, and the normal balance. Okay. So, number 1, checking, right? Checking, right, is the money in your bank. You own the money in your bank, so it's an asset. Okay. And because the money in the bank is already readily available in cash form, it's already liquid, it's going to be a current asset. And you normally increase assets with a debit. Okay. What about accounts payable? Accounts payable is when you owe somebody, right? You owe your vendors. So in this case, it becomes a liability. Now, oftentimes, you're most likely going to owe a vendor 30, 60, 90 days. So that's less than a year. So it's definitely going to be current. And it flows in the opposite. So in this case, liabilities are normally increased by a credit. Okay. Inventory, right? We purchase inventory. And when you purchase your inventory, you own it until you sell it. So therefore, it becomes an asset. And because it could be easily convertible, right? If I purchase my inventory, that means I can turn around and sell it the very next day. That means it is very liquid, right? I could definitely convert in my inventory into cash pretty instantly. So therefore, it's going to be a current asset. Okay? And we know assets are normally debited. You increase it with the debit. Okay. Next is supplies expense, right? It has its keyword in here, expense. Okay. So again, supplies expense represents us using the supplies during the accounting period. So this is going to be for the operations. Okay. And it is normally, right? So assets and expenses usually normally flow in the same direction. So it is normally increased by a debit. What about accumulated depreciation? What is accumulated depreciation? Accumulated depreciation is our contra account, remember? It is our contra account that we use to represent to decrease a fixed asset, right? To decrease the value of a fixed asset because we cannot change the value of the fixed asset because due to the historical cost law, right? So in this case, we need to create a contra account to decrease our fixed assets. Now in this case, right there, keyword, it flows in the opposite direction to decrease your fixed assets. So therefore, it's an asset and it's for fixed. And because it decreases, you're going to be crediting because it flows in the opposite direction, right? What about bad debt expense? Bad debt expense, once again, it's a regular expense account, right? It's got the keyword expense in there, right? And this isn't directly correlated to your cost, your inventory, so it can't be cost of goods sold. But this is definitely directly correlated to you selling your merchandise and the customer owing you money, and that customer fails to make a payment. So this is definitely for operations. Okay. And in this case, because it doesn't flow in the opposite direction, it's just a regular expense account. So in order to increase it, you're going to debit the account. Okay. We got inventory in here twice, so we could just skip that one. Unearned revenue. So remember, unearned revenue, revenue we haven't earned yet, right? In other words, when a customer gives us an advance payment for services we have not yet completed. So therefore, that gives us an obligation, right? That means we are required to provide service because we were paid in advance. So in this case, this becomes a liability because I now owe my customer the service. And usually, you would not likely owe them for a year later. So most likely, when you pay somebody in advance, you hope to have it done within a year. So in this case, since it's a liability, it's going to be normally credited. Okay? Accounts receivable. So once again, we're receiving money from our customers, or our customers owe us the money, right? We still sold the product. So in this case, what kind of account is this, right? Again, we own the money that our customers owe us, right? In this case, we could go, therefore, because we own the money that the customer owes us, right? And usually you're going to collect the money as soon as possible. So in this case, it will definitely be current, right? And since it's a regular asset, it will just be normally debited, okay? What about furniture, right? Furniture, when you buy your furniture, you own it. And in this type of furniture, right, falls in the PP&E, property, plant, and equipment, right? So property being the land, the sidewalks, the streets, where your plant is going to be your building, everything inside your building, so including your desk, table, chairs. So furniture is going to be considered part of the plant. So therefore, it's going to be an asset and it's going to be fixed. Okay? And to increase your fixed assets, you are going to normally increase that with a debit. All right? Owner's withdrawal. Right? Owner's withdrawal. Right? It's where you take money away from the company, right? So in this case, right, taking money away from the company is going to result in an owner's equity, right? Because in this case, you either invest your own money or you take out your own money, especially when you're a sole proprietor, right? You own that money that you put into your company. So therefore, you have every right to take the money out from your company. So in this case, it's going to be an owner's equity, and it's going to have no categories. Okay? And because it decreases owner's equity, it's going to have a debit balance, because normally you would credit owner's equity if you're trying to increase it, but this account right here is going to decrease it. Okay? Then we have sales. Sales is our main way we generate income or revenues. Okay? And this one is definitely going to be for the operations of the company, right? Operating income. Right? And to increase your sales, you are going to have a normal credit balance. Cost of goods sold, right? Cost of goods sold is what we use to represent, to use, get rid of, or to spend, right? In this case, this one's directly correlated to your inventory and your sales. So in this case, this is going to be an expense account with its own category, cost of goods sold. Right? And since it's a regular expense account, you are normally going to debit this account. Okay? Next one, you have depreciation expense. Depreciation expense, once again, has the keyword expense. Now in this case, right, depreciation expense is where you're just going to accumulate all of the or calculate all the depreciation for each of your fixed assets, and you're going to, represent to get that you used your fixed assets. So in this case, this is part of operations, right? Can't be part of cost of goods sold because it has nothing to do with your cost of goods sold. Okay, and since it's a regular expense account, it's going to be debited. Last but not least, we got the allowance for doubtful accounts. Allowance for doubtful accounts, once again, is a contra account, right? Because we have to use this to decrease our accounts receivable. So therefore, if we know what our accounts receivable is, it's an asset, right? And it's current, right? However, because it's a contra account, it flows in the opposite direction. So therefore, you're going to decrease your asset, right? Because that's exactly what an allowance for doubtful does. It decreases the accounts receivable. So therefore, it's going to be a credit balance. Okay. All right, section 4. Okay, so here we go. Under the rules of GAAP, which rule states that when you establish a business, you need to keep your personal and business transactions separate. In this case, right, it's going to be the business or economic entity. Okay, right, that's the definition, right? You got to keep your personal and your business separate. Number 5. If I purchased a machine for $500, okay, in my books, I must record it at $500, okay? Even if I sell it for $700, which GAAP rule states this? Okay, so in this case, you're not weighing any options here, so it can't be A. You're not measuring your machine, right? And in this case, historical cost, right? You're going to record it at whatever you purchased it, which is originally at $500, even if you can potentially sell it for $700, right? And get a gain. You're still going to keep it in your books at the original historical cost. So in this case, letter C, right? You're not recognizing any revenue unless the statement was that you purchased it for $500 and you sold it for $700. Therefore, you recognize that you got a $200 gain. That would be your revenue recognition. Okay? But in this case, this is just a historical cost. It's just telling you that you have to record it at $500. Number 6, okay? Customer A purchased an item for $15.65 from your store on an account, okay? A few days later, you receive a check for $15.65. You must properly record this sale and payment, okay? So which GAAP rule governs this? So in this case, it's not monetary unit because we're not, in this case, right? We're not measuring or we're not using a specific type of dollar for this transaction. Okay. Matching principle. Well, you sold something for $15.65 and now you received a payment for $15.65. That sounds like matching to me. Okay. And then full disclosure. In this case, what is there to disclose? This pertinent information. What other information do you have in regards to this transaction? There isn't any. And historical costs. In this case, you're not recording something at original cost and selling it for a higher price, right? So in this case, the only one that seems to be the most correct one would be your matching principle, right? You're matching your revenues with the amount that you received. Right? Number 7, cash basis is when, okay, Expenses are recorded when cash is received. That's correct. Expenses are recorded when it has incurred. No. Revenues are recognized when the sales has been earned. And then B and C. So in this case, correct answer is A, right? When you receive cash under a cash basis. Okay. Which of the following is not a step in the accounting cycle? So once again, let's take a look. Recording transactions in the general ledger. Yes, that is. That is step 4. And then B says producing financial statements. Yes, that is step 8. Letter C says trial balance. Yes, that is step 5. Making decisions based on your financial statements. Okay, so in this case, I don't think I ever mentioned one of those being a step, right? That's definitely not a step to accounting to any of it. And closing the books is step 9. So in this case, letter D is going to be your correct answer, right? That is definitely not a step in the accounting cycle. Okay. Chapter 5, right? So we're moving into periodic inventory. Okay. What are the tracking methods used for inventory? So again, periodic and perpetual would be your answer here. Right? Periodic meaning every once in a while, perpetual meaning constantly. Okay. Number 10, what are the costing methods used for inventory? So in this case, we looked at periodic, FIFO, LIFO, and weighted average. We also looked at perpetual FIFO, LIFO, weighted moving average. And specific ID is an existing costing method. We just don't talk about it. So in this case, all of the above. Okay. Number 11. When delivery charges are made COD, what does that mean? Well, does it mean currently ordered discharged? Does it mean code on demand? Does it mean cash on delivery? Or does it mean crate on departure? So in this case, cash on delivery. Okay. Number 12. Okay, what is the definition of periodic and perpetual? So in this case, I kind of gave this one to you, right? Periodic means once in a while, and perpetual means constantly. So there you go, letter A. Okay. Number 13. True or false, at the end of the period under the periodic tracking method, a conversion entry is needed. Okay, so remember at the end of our periodic inventory, right? We need to complete a conversion entry to convert our expenses into inventory and cost of goods sold. So this answer is definitely true, right? You definitely need to have a conversion entry at the end of the periodic inventory. Okay. All right, let's do an example here. Okay, use the following information with the table to answer the next 2 questions. So here we go. All right, most important thing that you need to know here is your tracking and costing methods are periodic and it's LIFO. Okay, so we do the last in, first out first. Okay, so in this case, right, we gotta look at our inventory purchases. So in this case, on June 1st, right, we purchased 100 toys costing $1 each, with the freight costing $25. So in this case, right, purchase price is 100. Freight cost plus freight is 25, so there would be 125 is your total cost. Because you're using LIFO, you need to calculate your cost per item, which is going to be $1.25. Okay. Then on June 10, okay, June 10, we purchased 200 units costing at $1.25 each. Okay, with the freight costing $50. So in this case, right, 200 at $1.25 is going to give you $250. Plus 50 is going to give you a total of $300. Divide that by your 200, should give you $1.50. Okay. On June 12th, you sold 200 toys at $5 each. In this case, we're doing periodic inventory, so we don't care about our sales. So we could skip that one and move right forward to on June 15. Okay, so June 15, you purchased 300 toys, costing at $1.50. Okay, with a freight of $75. So again, you have 300 units, okay, at $1.50, which will give you a total of 450 $450 plus 75 should give you $525. Divide that by 300, you should get $1.75. Okay, and once again, June 20th, you end up selling 250 units, which we don't care. So therefore, on June 30th, you had a total of 150 toys on hand, which I already filled in for you. So if you added up your totals, you should have a total purchase of 600 units at a total cost of $800 plus 150, giving you a total of $950. Okay, so first things first is we got to remember we're using LIFO, right, as your costing method. So in this case, if I have 150 left remaining, I must have sold, right? If I start out with 600 and only have 150 left, I should have sold 450 units. So because we're using LIFO, right, we need to figure out how many items we sold. So in this case, first thing that we have here is we need to sell a total of 450 units. Last batch that we purchased was this batch of 300 units at $1.75, which we know to be $525. Okay, so that's my very first one. Now I sold 300. I need to sell 150 more at $1.50. Okay, so that's going to give you a total, okay, of $1.50 times 150 should give you $225. You add those all up, you should get a total of 450 units at a grand total of $750. Okay, and then there you go. So $750 goes here. So therefore, your total ending balance, right? If you do the calculations, right? If you do 25, or sorry, you do 50 times $1.50, right? 50 times $1.50 gives you 75 plus 125 from the previous batch. You'll get your $200 there, okay, as your ending balance. Okay, so let's go ahead and answer the questions here. Number 14, okay. What is the total cost of your ending inventory on hand? 150 units. Right here should be $200. Okay. And what is the total cost of your cost of goods sold? In this case was $750. Okay. So be aware of what you're doing because I could include answers from the other different costing methods in here. Okay. So here, right, if the use the following information from the table to answer the next two questions. So once again, if you take a look at the scenario, June 1st, you made a purchase of 100 toys at $1. June 10, you made 200 purchase of 200 toys at $1.25, and then June 15, you made a purchase of 300 toys at $1.50. Now in this case, this is the exact same scenario as up here, so I could just go ahead and save you some extra time to copy all this information. Okay. But here's what's different about this one is your tracking and costing methods are periodic and it's FIFO this time. There you go. It's FIFO this time. So therefore, I don't know why it added that in there. Okay. So therefore, we need to calculate here using FIFO this time. Okay. Since we only have 150 left, that means we assume that we sold 450 units, right? 600 minus 150 will give you 450. And in this case, right, which batches of inventory are we going to sell first? In this case, you're choosing first in, first out. So therefore, we're going to get rid of my very first batch at 100 units at $1.25, which will give you 125, right? So it's only 100. I need to sell my 200 at $1.50, which will give me $300. Okay. And therefore, let me see, that's 300. I need to sell 150 at $1.75. Okay. So 150 times $1.75 is going to give me 262.50. Add those values up together, you should get a total of 450 units sold at a grand total of $687.50. Okay, 687.50. Yes. Okay. 687.50, and of course, you should have a remaining of 150 left at $1.75. So therefore, you already did the calculation here. Will give you $262.50 left. Okay. So what is the total cost of your ending inventory on hand? 150 units gave you $262.50. And then here, what is the total cost of your cost of goods sold? Gave you $687.50. Okay. So last one we have here is weighted average, same exact one. So again, I'll save you some more time here to just copy table, the information from the table. Okay. But this time, right, to calculate the costing method is going to be weighted average, right? So again, your inventory tracking and costing method is periodic weighted average. That's why I didn't copy the cost per item, because you don't need it, right? You don't need to calculate that. However, let's see. It says here also that you're going to be answering 3 questions this time. So let's see. Okay. And you had a total of 450 units here that you sold. So in this case, right, we have a total of 600 units at a total cost of 950 units. So in order to get our weighted average cost per item, you're going to take your total cost of 950 and divide it by 600, and you should get 1.58. So let me see. So you're going to take 950 divided by 600, and you should get 1.58333. Okay, so that will be right here, 1.583333. Now, we need to know how much it's going to cost me to sell 450 units at 1.583333, and that should give you a total of $712.50. $712.50. So that should give you a remaining of $237.50. $237.50. Okay. So let's answer the question. What is the total cost of your ending inventory on hand? We had $237.50. Okay. And we had your total cost of goods sold was the $712.50. Okay. Okay. So then now it says question 20 is to do a conversion entry. So once again, we're assuming this is June 30th, right? We always have to remember ending inventory. So in this case, we know exactly what we purchased, right? We purchased toys, okay? We need to also recognize that we sold some of those toys along the way, and that we're converting from purchase expense, and we're also needing to zero out my freight expense. Okay? So again, first one here is, what was your total ending inventory? It was at $237.50. The cost of goods sold was at $712.50. Now, how many total did you purchase? You purchased $800 worth of inventory with $150 worth of freight. So there you go. Okay. So question number 21, if on June 17 you received 10 broken mugs and you requested a full refund from the vendor, what accounts will you journalize for the return if you are using periodic inventory? So here's the key word, periodic inventory. So in this case, what are you going to use? Are you going to use a purchase returns and allowances? Are you going to credit your purchase returns and allowances? Are you going to debit your inventory? Are you going to credit your inventory? So in this case, periodic inventory, remember, is an expense account, right? We need to refer it as an expense account. And in this case, you can't really undo certain expense accounts. So this is going to be one of them. So you need to create a contra account. So in this case, purchase expenses are normally debited. So if you need to decrease the value, you're going to credit your purchase returns and allowances. Okay, if you need to journalize it, go ahead and do so, but you're going to need to credit your purchase returns allowance because you're reducing the purchase expense account. Okay. Number 12, if terms are 5%, 15, net 30, what does that mean? So let's take a look. A says take a 5% discount if you pay within 15 days. If not, pay in full within 30. Well, there you go. That seems to be right on point. Okay, B says take a 5% discount if you pay within 30 days. If not, then pay in full in 15. That's not correct. C says if you have 15 days to pay. If not, you will get fined 5% within the next 30 days. So that's obviously not correct. Okay. So therefore, A is your answer here. Okay. Number 23, what does net method mean? Net method means you're going to take the discount later or you're going to take the discount immediately. So net, once again, you're going to take that discount immediately, right? So now moving into chapter 6 territory here. Okay. Number 24, if a customer buys 10 shirts for $5 each, sales tax is 8.25%. Total cost of sales was $54.12. The next day, the customer wants to return 5 shirts because they were the wrong size, and the customer demands a full refund for the 5 shirts. What should the journal entry look like? Okay, assume that you are using periodic inventory. Okay, so in this case, right, if a customer purchased from you originally 10 shirts, okay, so you charged them tax, right, of 8.25%. So if you're giving them a refund, right, what are you going to do? You're going to debit your sales returns and allowances. You're going to give them a portion of the sales tax money back, and you're going to give them money. So in this case, the correct one is going to be letter C, right? You can't forget the sales tax. If you originally charged it, that money, it doesn't belong to you. It belongs to the government and or the customer. Okay? So C would be your correct answer here. You're not selling to the customer, and you're not, in this case, you're not going to hold back that sales tax. So in this case, letter C would be the correct answer. So I'll go ahead and push this question down here. Okay, so question 25. When there is a store-wide sale discount for 40% off, you can only take a discount on what items? So in this case, merchandise selling price only. Yes, you cannot discount sales tax. You definitely cannot discount shipping and handling. And none of the above is not the correct answer. So in this case, you can only take a discount off of the merchandise selling price. Okay. Now it says here, use the following table to answer question. So the next question. So in this case, right, you're given a table, right, for the lower cost of market. And so you need to determine the ceiling, floor, and ceiling, ceiling, floor, market, and which one's lower, right? So in this case, how do we solve for ceiling price, right? Ceiling's going to be your selling minus disposal. And that is, let me see, we sell our product for $10.50. To dispose it's going to cost me $1.33. So therefore, you should have a total your total here. So $10.50 minus $1.33 should give you $9.17. Okay. Okay, so $1.17 at $9.17. Then your floor price is going to be your ceiling price minus your profit. So that should be your $9.17 minus $3.55. And that should give you a total of $5.62. Okay? Then you're going to compare, right? You're going to compare your replacement cost of $4.05 compared to your ceiling of $9.17 and your floor for $5.62. Which one falls in the middle? Your $5.62. So which one's lower? Your original cost of $4.75 or your market at $5.62. In this case, there's a clear winner. Your original cost of $4.75 is much lower. Okay. All right. So next section here is going to be section 7 or chapter 7 here, right? So it says right here, questions 27 through 30 are related. Okay, so question 27, okay? Your tracking method is perpetual, okay? If on June 1st you made a purchase of 100 coffee mugs for $2.35 each, and freight is $100, you purchase this on an account. Record this transaction. So once again, right, in this case, it is June 1st. You purchase 100 coffee mugs. So in this case, you're going to be debiting your coffee mugs. And their keyword here is that you placed it on an account. Okay? So in this case, you purchased 100 units at $2.35. Okay? Plus you had a freight of $100. So therefore, you're going to journalize that you're going to have $335, right? Because in this case, you're including both the purchase price and the freight, right? For $335. Okay. Then the next question says, right, question 28, if on June 7 you received your coffee mugs and found that two of them were the wrong were correct. So you requested a refund from your vendor. So record this transaction. So in this case, right, it's June 7. You ended up returning the merchandise. So in this case, it's going to reduce your accounts payable. And you're going to take that out from your coffee mugs. Now in this case, 2 of them were broken. So at what cost or at what unit price did I originally purchase all of my mugs at? In this case, I purchased them at $2.35. So therefore, 2 times $2.35, right, is going to give you your $4.70. So $4.70. Okay. So now, question number 29. On June 8th, you sold 25 coffee mugs for $10 each. And it cost you $3.37 each. Okay? So again, assume that there are no sales tax and all sales were made with cash. So therefore, right, we have to remember it's June 8th. And since we're doing chapter 7, which is perpetual inventory, we're going to recognize the first thing is we sold our coffee mugs, right? So therefore, cash and sales, right? No sales tax. If you sold 25 mugs at $10 each, that means you're going to get 25 times 10, which is $250 per mug. Okay? Or for the total of 25 mugs. And if it cost you $3.37, then that's where you're going to recognize your cost of goods sold. And you're going to update your inventory. So now you are going to figure out what 25 mugs cost you at $3.37. And in this case, it's $84.25. Okay. And then last one, question 30. If on June 10, a customer returns 2 coffee mugs for a full refund and you sold each mug for $10, okay, and it cost you $3.37 each, record this transaction. So in this case, right, we need to recognize that the customer is returning the product. So if on June 10, you're going to recognize sales, returns, and allowances because that is, right, the customer's returning the product and you're going to give them back cash, right? And if you sold each coffee mug at $10 each and they end up returning 2 of them, so 2 times 10 will give you $20, right? We didn't charge sales tax. And therefore, because we end up giving the customer a full refund, you have to remember, you're going to have to also put that coffee mugs back into inventory. And undo the cost of goods sold. So therefore, if each coffee mug costs you $3.37, right? $3.37 times 2 will give you $6.74. Okay. All right. All right, so now we're moving on to Chapter 8, Territory. So this is going to be us practicing our inventory worksheets here. Now in this case, if you remember, since perpetual inventory, right? Even if the scenarios are all the same, you have to calculate them differently, right? Because every transaction that you do is going to be different, right? Because it depending on what you're doing. Every purchase that you make and every sale that you make, you're going to have to take them out in between. So you can't copy and paste this one in this case. So it said right here, use the following information and table to answer the next two questions. So most important thing that you need to remember here is you need to know this. You need to know the tracking and the costing method. So your tracking and costing method is perpetual LIFO. So that means we're going to take last in, first out. Okay? So starting from the first one here, on June 1st, you purchased 100 toys costing at $1 each with a freight of $25. So in this case, skip over. You purchase 100 units at $1 each, which gives you $100 plus 25 will give you a total cost of 125. And because it is LIFO, we need to keep our inventory on track. So in this case, LIFO is going to give you $1.25 each, or because we are using LIFO, you need to separate your batches here. Okay. Next one says here, June 10, you end up purchasing another 200 units at $1.25 each with a freight of $50. So June 10, right? We purchase another 200 units at $1.25, which gets you $250. Plus 50 will give you 300, which will give you $1.50 each, right? Calculations from above. Now here's what's different. On June 12th, you end up selling 200 toys at $5 each. So in this case, right, if I'm using the rules of LIFO, on June 12th, I end up selling 200 units. Now in this case, LIFO tells me I need to get rid of my last batch that I purchased, which in this one conveniently is exactly 200 units. So in this case, 200 units at $1.50 is going to give me a total of 300. So therefore, you can subtract that out. Right? And I will give you 0 out for that one. Okay? So that means I only have this one batch of inventory left, right? This 100 units. Oh, sorry. I was supposed to hit the top one up here. Okay? So that means I only have that 100 units left. Okay? But in this case, right, on June 15, you end up purchasing your 300 units, right? So in this case, June 15, we purchased 300 units at $1.50, giving you a total of $450 plus $75 freight, which gives you $525, which gives you $1.75 each. Okay? And then we end up selling 250 of those units on June 20th. Okay, so June 20th, we sold 250 units. Now in this case, last in, first out, we're going to be looking at the latest batch that we purchased, which is going to be costing at $1.75 each. Which, if you calculate that, right, 250 times $1.75 is going to give you $437.50. Okay, so therefore subtract 250. You should have 50 remaining minus 437.50. Okay, should give you a total of $87.50 left, right? And that should, if you add up your other batch from earlier, you should have a total of 150 units left. 87.50 plus 125 should give you a total of 212.50 left on hand. Okay? And if you calculate your total cost of goods sold here, you sold a total of 450 units. And we're going to add these values together so you get 737.50. Okay. So let's take a look. All right. What is the total cost of your ending inventory on hand? 150 units. 150 units left remaining should give you a total of $212.50, right? And of course, what is your total cost of goods sold? Should be your $737.50. Okay? So that's LIFO for you. Now let's practice this one. Moving average. Okay? Moving average. So once again, okay, June 1st, you purchase a total of 100 units at $1 each with a freight of 25. So therefore, that should give you 125, which in this case, your current average cost per item is $1.25. Okay? But then it says here you made a purchase on June 10. Okay? You made a purchase on June 10 for 200 units at $1.25, which gives you 250 plus 50 will give you a total of 300. So in this case, because I'm using moving average, right, I need to calculate my grand total. So in this case, I have a total of 300 units at a grand total cost of $425. So I need to figure out what my cost per item is here, right? Because I'm going to take $425 and I'm going to divide that by 300 units, and you should get $4.166667, right? So I'm going to take that, and the next one says here that you end up selling 200 units. So therefore, June 12th, we sold 200 units at 1.416, and that's going to give you a total of 283.33. Okay, so you subtract that out, 200, so you can have 100 left, minus 283.33 is going to give you a total of should give you a total of the should give you a total of 141.67. Okay. Which again is going to give you a cost per item of 1.4166 or 67 in this case. Okay. Then we end up making a purchase on the 15 for 300 units, right? June 15, you purchased 300 units at $1.50 plus a freight of 75, so 150 will give you 450 plus 75 should give you 525. Okay? So now I need to add those values up because now I have 400 units available at a new total cost of 666.67. So therefore 66667 divided by 400 should give you 1.66. How many sixes? 4 sixes. 4675. Okay. So then, last but not least, it says here that on June 20th you end up selling 250 units. Okay. On the 20th, you sold 250 units at that 1.6666. So that should give you $416.67. Okay, so if I subtract that 250, I should be left with 150. Subtracting 416 and 67 cents should give you an ending balance of $250. Okay, and then your ending here, right? We know that we sold 450 units at a grand total cost of 0.0007. You would have sold a total of $700. Okay, so again, what is the total cost of your ending inventory on hand? Right, we got 250 units or $250 for 150. And then what is the total cost of your cost of goods sold? We sold a total of $700. Okay, so again, this is what I mean by I'm going to be doing very simple calculations here. So just make sure that when you calculate up to 6 digits on the cost of goods sold, and you'll get your correct answer. It should be a rounded number, okay? Or when you round up your answer, it should be obvious, okay? All right, so now we're moving on to Chapter 9 territory. So again, over there, if you want to practice FIFO, there's many examples on the Google Classroom for you to do FIFO. All right, here, so so chapter 9 says right here, use the following information to answer the next question here. So if on January 1st you establish a petty cash fund for $500. All right, and then on January 31st, you counted your receipts. Okay, so here you have a total, right? You purchased a birthday cake, right, for $19.99. Okay. You also purchased a pizza, okay, for $23.78. Okay. And you also purchased some office supplies for $6.02. Okay. And last but not least, you had to pay for postage stamps for $10.75. Okay. So in this case, how do you replenish? The question says right here, for what amount do you need to write a check to replenish your petty cash fund? So in this case, right, how do we replenish our petty cash fund? We add up the total amount of receipts, we write a check, and that money is going to go back into your petty cash fund, so then you can start your petty cash fund for what you originally started with, which is that $500. So in this case, if you added them up, you should get $60.54. Okay. Next one says, question number 36, how do you establish a petty cash fund? Right? Do you debit petty cash and credit checking? Do you debit checking and credit petty cash? Do you debit petty cash and credit all the expenses? Or do you debit all expenses and credit petty cash? So in this case, we're establishing. So in this case, where does your petty cash money come from? It comes from your checking account. Okay. Number 37, how do you replenish a petty cash fund, right? In this case, are you going to deduct all of the receipts in the lockbox from the petty cash fund? B says, are you going to write a check for in the amount of the total receipts in the lockbox from the petty cash fund? Okay, that sounds most correct. You're going to write a new check for a larger amount to the petty cash fund, okay, in the lockbox. Not a larger amount, okay? And then D says you're going to count the petty cash fund and write a check for the same amount. So in this case, this one is going to be letter B, right? You're going to write a check for the total amount of receipts that are in the lockbox. Okay. Now we're moving into chapter 10, question 38. Under which method does the IRS use to write off bad debt, okay, for tax purposes only? So once again, we said this was the direct write-off method, right? You're directly writing off the accounts receivable, which in this case, a regular accountant cannot do, right? So in this case, it's done for tax accountants and for IRS purposes only. Okay. Number 39, okay, if a company estimates that $34,887 of its $500,000 accounts receivables is to be uncollectible, okay, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be. So, once again, we're assuming it's December 31st. Our first thing we need to recognize is this is going to be a bad debt expense because it's the end of the year and we're making an estimated amount. And it's going to come from the allowance for doubtful accounts. Okay? Now, in this case, right, what is the rule of thumb here? Which method are we going to be using? Okay, so keyword here is accounts receivable. So therefore, that's going to tell you that you're going to be using the balance sheet method. So therefore, if we're using the balance sheet method, that means the allowance for doubtful accounts appears on the balance sheet and it will affect your result. So in this case, you have a debit balance. So that means you're on the left side. Okay, $5,000. You need to be on the right side, 34,887. So therefore, you're going to add those two values together and you're going to get 39,887. And so therefore, your correct answer is, did I say 39,887? Yes, and there it is, 39,887. Okay. So once again, if a company estimates that 34,887 of its total credit sales, 500,000 total credit sales, is uncollectible, there is currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be, once again, we need to identify. In this case, it says total credit sales. Total credit sales means you're using the income statement method. Now, under the income statement method, right, the allowance for doubtful accounts and accounts receivable do not appear on your income statement, right? Your income statement's only your revenues and your expenses, right? And accounts receivable is not a revenue. So therefore, it does not affect the overall amount. We don't care what's in the allowance for doubtful accounts. So therefore, it should be for whatever the estimated amount is, which is the 34,887, right? And you're going to get the same exact journal entry here. Okay, so in this case, this is for the 34,887, right? Because we're using the income statement method. Okay, so therefore, 34,887 is letter A. Okay, so number 41, same scenario, except a company estimates that 34,887 of a 500,000 accounts receivable is to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be, so once again, this time we're using the balance sheet method because we see the keyword accounts receivable. However, it tells you that you're already on the right side, 5,000. So you need to get to 34,887. So how many more steps do you need to go to the right to reach 34,887? In this case, you're going to subtract the two numbers, and that will give you 29, right? Minus 5,000 will give you 29,887. Okay, so 29,887. And so therefore, your letter answer here is letter C. Okay. Last one here for question 42. If a company estimates that 34,887 of 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be, once again, we need to identify that this is the income statement, right? So therefore, whatever balance there is in the allowance for doubtful accounts, we don't care. So therefore, we only care about the estimated amount of the 34,887. So in this case, this is going to be 34,887. Okay. So now we are going to be doing an example of a bank reconciliation. So bank reconciliation, right? I will provide you a bank statement, but it's not going to look like this, like I said, from the chapter 9 and 10 exercises would be what your bank reconciliation will most likely look like, right? 3 tables with all the information that you need, and you need to be able to do the bank reconciliation. But for this is practice purposes. So here you have the bank statement. Okay. Here I also provide you the cash ledger and the check register, as well as your receipts and deposit slips. Okay, so in this case, which side are we going to be looking at? So let's go ahead and do the bank side first. So what is the ending balance in your bank account? So bank statement. So you're going to look at your bank statement. Okay, so it says right here that you began as of July 31st, you began the bank account with $851. And now at the end of August 31st, you now have $1,088. So therefore, that's what I'm going to put in here in my section here, that I have $1,088. Okay. What are things that I need to add to my bank account, right? So again, you're gonna be doing, you're gonna have dues, right? You're gonna do in your bank. So in this case, that's gonna be deposits and transits and outstanding checks. So again, deposits. Okay, you have 1 deposit, 2 deposit, 3 deposit, 4 deposit, 5 deposits. And how much has your bank recorded that you have cleared? In this case, you only have 4 deposits that actually cleared. So usually rule of thumb is if you make a deposit at the end of the month, it's going to carry over into the next month. So in this case, let's take a look here, right? You have 360, 297, 284, and 126. So let's take a look at my deposits. Here's my 360, 297, 284, and 126. I am missing my last deposit on August 30th for $483 even. So $483. So deposit on 8/30 for $483. Okay. Okay, so now we gotta take a look at subtracting out any checks that have yet cleared. So in this case, let's take a look at my check numbers. So I got 102 or 302, 301, 302, 303, 304, 305, 306, 307, and 308. So let's take a look here. Okay. Check 301 cleared, 302 cleared, 303 cleared, 304 cleared, 305 cleared, and then it jumps right over to 308. So in this case, I'm missing 306 and 307. So here they are. 306 for $314, and then I have 307 at $54. Okay, so therefore, let's see. Check number 306, and you got check number 307 for $314, and you add it for $54. So in this case, you need to subtract a total of $368. So let's do our calculation, right? If you started out with $1088, you need to add $483. Okay? And you need to subtract out $368. Okay? That should give you a total of $1,203. Okay? You don't stop there because you need to make sure that your totals equal on both sides. Okay? So in this case, we need to go ahead and solve for our cash side. So my cash side, what's my ending balance on my cash ledger side? Okay, so let's take a look at my cash ledger. The way that you read a ledger is usually your account balance is going to be the very last thing that you entered in here. So in this case, on August 31st, I subtracted $82. So therefore, I have a total of $1,153. So $1,153 is what I'm going to start out with. Okay. What do I need to add? Well, in this case, I need to see if my bank has collected any money from me. So in this case, I have an ACH for $125 and a interest of $75. Okay, so therefore, let's see. I got interest for $125. So interest, and you had an auto clearinghouse. So $125, and I had $75 worth of ACH. Yes, so therefore I need to add a grand total of $200 to my cash side. Okay? And then I need to check to make sure that I have to take out all the fees that were charged to my bank, right? So let's see what those are. Okay, so usually they're always at the top of your window. So here you got charged a service charge and an NSF fee for $50. Okay, so $100 service charge and $50 NSF fee. Okay, so here you're going to subtract your service charge, $100. And you're going to also you had an NSF fee of $50. So therefore, you need to subtract $150 from your account. Okay, so what is this? If you started out with $1,153 plus 200 gives you $1,353 minus $150 should give you 1153 plus 200 minus 150 should give you 1203. And so your answer here is, what is the adjusted balance in the bank and cash ledger? It's going to be for 1203. Okay. So here you go. That was the bank reconciliation. So moving on to question 44 here. You bought a bank bond worth $200,000 and its annual simple interest rate is 7.75%, okay, and can be redeemable at the end at any time, okay? How much will the bond be worth in 10 years? So this one is your simple interest question here, but here, what is this question asking? Is it asking for how much interest I have, or is it asking for future value? It says how much will the bond be worth in 10 years. So therefore, it's looking for future value. So in this case, we need to calculate, right, principal times rate times time to get our interest. So in this case, you're going to take 200. You're going to take 200,000. You're going to multiply that by 0.75%. 0.0775. And because it's in 10 years, you're going to multiply by 10 years, and your interest should be $155,000. Okay? And to get your future value, you're going to add your principal, all right, of $200,000 to get you a total of $355,000. So in this case, that is your future value, the $355,000. Okay, so be careful what I'm asking you. Am I asking you for interest or am I asking you for future value? Okay. Where question 45 says, if a credit card company lets you borrow $500 at a simple interest rate of 28.9%, okay? How much interest will be collected at the end of 2 years? So this one's asking me how much interest am I collecting? So in this case, I need to do my simple interest because it's a simple interest problem once again. So you take your $500, you're going to multiply by 0.289, right? And you're going to multiply that by 2 years. So therefore, you should be having a total interest of $289. And that is answer for letter A. Okay? All right. Next is going to be chapter 11. Chapter 11 here. We got question 46. What fixed asset can never be depreciated, right? Land is going to be your answer. Why? Because land can only be depleted. Okay, cannot be depreciated. Okay, where buildings can be, parking lots, and 100% streetlights can be as well. Okay. Number 47, okay, if fixed assets are depreciated, then intangible assets are amortized, okay? So that's a terminology, okay? Number 48, if a machine was put into service on January 19, when do you start depreciating it? So again, right, the rule is if it's within the first half of the month from January 1st to January 15, okay, then you're going to depreciate it because it's been used for more than 50% of the month. But if it falls after the 16 all the way to 30 or 31st, then you're just going to go ahead and say it's less than the month, so you're going to depreciate it the following month. So therefore, since it's January 19, you're going to assume that you're going to depreciate it as of the next month, February 1st. Okay? Number 49, GAAP determines what two components for depreciation, right? They did the estimated useful life of an asset and salvage value. So in this case, both B and C only is your answer. Okay, because they didn't determine partial years, but they definitely determined the estimated useful life and the salvage value. Okay. Number 50, what are the 3 depreciation methods? So once again, we talked about double declining. We talked about straight line, the most easy and common one that a lot of companies use, and units of production. So in this case, all of the above. Okay. Number 51, under the double declining method, at the end, book value must be equal to your salvage value. Okay, cannot fall below. No assets when you depreciate can fall below salvage value. Okay, but under double declining, right? Because we have to be very careful because we're depreciating it twice as fast. So therefore, we need to make sure that our book value does not fall below salvage value, even if it's before the end of its estimated useful life. Okay. All right, so again, use the table below to answer the next two questions. So once again, right, here's our table. We got a computer that we purchased for a total of $2,500. We're going to be using straight line method. Salvage value is 0. Estimated useful life is 5 years. Date that you place into service is January 5th. Okay. So in this case, first year, so let's go ahead. Depreciation basis is going to be, for straight line, is basis, which is going to be your asset cost minus salvage values. In this case, asset cost of $2,500 minus salvage value of 0 will give you $2,500. Okay? And the depreciation rate is going to be 1 over the estimated useful life of 5 here, right? So that's going to give you 20%. Okay? 20% times $2,500. Okay? 2,500 times 20% will give you $500. So accumulated depreciation for the first year should be $500. Book value is going to be $2,000. Right? It's going to take your asset cost of $2,500 minus your accumulated of $500 should give you a book value of $2,000. Okay? What about for the second year? Okay, second year, right? What's depreciation basis? It's going to be your asset cost of $2,500 minus salvage value, which gives you the same $2,500. Your rate is also going to be 1 over the estimated useful life, which is going to be another 20%. 20% of $2,500 gives you another $500. However, since first year you already depreciated $500, you're going to add another $500 to give you a total of $1,000 of accumulated depreciation. So therefore, your total book value should be $2,500 minus $1,000 should give you $1,500. Okay. So the questions here says, 52 says, what is the depreciation expense for year 1 and year 2? My depreciation expense is $500. Okay. Then it says here, 53, what is the book value at the end of year 2 for year 2? In this case, $1,500, right? You need to make sure you fill your table all the way out because it could ask you questions in regards to the first year, the second year, book value, okay? Depreciation expense. Any question is valid. So in this case, what is the value of my book value for year 2? $1,500. Okay, because we depreciated $1,000 for your assets. Okay. Next one says here, use the table below to answer the next two questions. So this time, right, we're looking at our asset. It's a printer, right? The depreciation method's units of production. You purchased this for $500 with no salvage value. The number of units that it could produce is 10,000 pages. The date that you place into service is January 2nd. Okay, and this is what you had for the first 2 years. So again, depreciation basis for units of production is going to be your asset cost of $500 minus salvage value of 0 will give you a total of $500. Okay? Now your per unit price is going to be your depreciation basis divided by your total number of units that you can produce. So in this case, $500 divided by 10,000 pages is going to give you 0.05 cents. So 5 cents per page. Okay, that's how the unit per unit rate is going to be, is how many pages, so how much would it cost per page. Okay, so this case depreciation expense is going to be your number of units that you produced that year times the per unit rate. So in this case, I printed out 2,500 pages, and that gave me a total of $125. So therefore, accumulated depreciation for the first year is $125. $125, we're going to subtract that out of the $500. Should give you a total of $375 for your book value. Okay? What about the second year? Depreciation basis is going to be asset cost minus salvage value. So in this case, it's still $500. Your per unit rate is going to be your depreciation basis of 500 divided by your number of units that you could produce by 10,000. So therefore, you're still going to get your 5 cents per page. Okay? And this time, right? This time, for the year 2, we only printed out 2,000 pages. Okay? So therefore, you should have a total of $100 that you depreciate. Okay? And you're going to count the previous one from last year, so you're going to have $225. So therefore, you're going to have $275 as your book of value for year 2. Okay? So the question here says 54 says, what is the depreciation expense for year 1? So depreciation expense for year 1 was $125. Okay, so be careful. I could include all the answers. Okay. 55, what is the book value for year 2? Okay, after depreciating it for $225, you should have left over $275. Okay, is your current book value. Right? Last problem for this study guide here is to do the very last method. So once again, you're going to use the table to answer the next 2 questions. This time, we're going to be using that same computer, and we're going to use double declining method instead. Your asset cost is $2,500. Salvage value is 0. Estimated useful life is 5 years. And you decided to put it in service as of January 5th. So depreciation basis is going to be beginning of the year's book value. So therefore, since I haven't depreciated at all, it's going to hold a value of $2,500. Okay? Your depreciation rate, since you're double declining it, you're going to depreciate twice as much. It's going to be 1 over the estimated useful life times 2, which in this case gives you 40%. So 40% of $2,500, right? Because $2,500 times 40% is going to be $1,000. So therefore, your accumulate is 1,000, and now your book value, right? 2,500 minus 1,000 is going to be 1,500. Okay? Now, this time for year 2, depreciation basis is going to be the beginning of the year's book value. The end of year 1 will become the beginning of year 2, so therefore, it's going to be $1,500. Okay? Your rate is still going to be the same of the 1 divided by the estimated useful life times 2, which will give you 40%. So this time, what is 40% of 1,500? Okay? 40% of 1,500 will give you $600. So therefore, you're going to have a total accumulated of $1,600. So therefore, if I subtract that out of my asset cost, that should leave me with $900 left. Okay. So, 56 says, what is the depreciation expense for year 1? It's going to be $1,000. Okay. And last question here is, what is the book value for year 2? right? We calculate it to be $900, right? And that is it for the study guide for your midterm, okay? So make sure that you do study more than what is on here, okay? And you can utilize this study guide for your exam, okay, to help you out, to kind of give you an idea of what to expect. So again, simple numbers. I'm not going to have you fill out a whole 5 years worth of depreciation. I'm only going to test you maybe 1 or 2 years per, maybe for every single depreciation method that we've learned, okay? And same thing with the periodic and perpetual tables, right? Simple, simplified numbers, okay? All right.